Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Dave Foreman of Praetura Ventures to talk about their VCT and EIS funds. Hello Dave, welcome back to the studio. So we're here to talk about the VCT and EIS fund. Taking the EIS fund first, what does it aim to do for investors and what differentiates it?
Yeah, so we launched our EIS Growth Fund in 2019. It is an EIS fund that is aiming to give investors access to opportunities in early stage, high growth companies, predominantly in the north of England and predominantly in tech. We're aiming to produce significant returns, maximise the EIS reliefs, and play our part in building the ecosystem of early stage tech companies outside of the London-centric focus of the UK.
Yeah. And you've recently also launched a VCT.
Yes, we have. Yeah, we're really excited about the VCT. Felt like a really good time to launch a VCT. One that's new, it's clean, it doesn't have sort of some of the issues that funds that were raising and investing a lot of money during 21 and 22 when valuations were sky high may have in sort of performance and valuation. So we felt that bringing a new VCT, a clean VCT to market in early 2024 was a real opportunity, and we're hoping to build that and grow that over the next 5-10 years.
And is the VCT always going to co-invest alongside the EIS funds?
It's got a slightly later stage mandate than the EIS fund, so there will be opportunities to co-invest, but there will also be investments that are predominantly VCT-led. So our VCT is looking either to be participating in significant funding rounds or businesses that have got sort of 5 million of revenues or ARR if you take the tech businesses. Our EIS funds are probably a little bit earlier stage, sort of 1 million to 5 million ARR is kind of the entry point for those businesses.
And taking a step back, Praetura Ventures, for those who aren't familiar, who's Praetura Ventures?
Yeah, so I'm one of the founders of Praetura. So we've built since 2014, we've built two businesses, one side lending and one side the venture business. As a sort of group of companies, we're now at about 800 million AUM. The venture side of that is 300 million of the AUM there, split between public sector funds and EIS and VCT, sort of retail investment funds. I'm the managing partner of Praetura Ventures. I look after the entire ventures business. And my role really is to help the team find and back exceptional founders for certain businesses in the portfolio and generally across the sort of wider portfolio, help those founders build the best business they can. And then I also sort of do some bits of raising AUM and talking to our investors and their advisors.
Oh, good. And the types of companies you're looking to back within EIS and VCT?
Predominantly tech. Yeah. So technology, I think we've got a large concentration of B2B SaaS businesses, so technology businesses, predominantly selling into enterprise software, where we're looking to solve real pain points within the customer, ideally be saving costs rather than sort of the nice to have revenue enhancing type things. Mm-hmm. So solving real pain points with relatively high sort of average contract values and life cycles. And particularly what we're looking for is things that when they're in with a customer, when they've been integrated, when they've been rolled out, they stay in for a long time and they become very sticky parts of the business.
There's a very strong North of England theme to Praetura.
Yeah, so we're based in Manchester, which makes us relatively unique in the world of venture capital in the North of England. So the North, for those who don't know, is about 20% of GDP, which is about the same as London, and number of companies and sort of number of people. But yeah, only 3% of VCs live and work in the North of England. So we think that gives us a real opportunity to back founders and talent in parts of the country that aren't normally served by the traditional sort of venture capital based in London, which gives us an opportunity to buy local, sell nationally and internationally, and access a bit of valuation arbitrage there. When we go in, our valuations are generally lower than would be the case for London founders. And we're big believers that talent is distributed across the entire country, but access to capital is very, very London centric. Yeah. And if we can help play our role outside of that area, we think that is a good thing to do from a sort of societal basis, but also gives us access to great founders at attractive valuations where we can make significant returns.
And is there a particular stage that you focus on? Is it quite early or?
Within the EIS funds, it's probably the average deal would look something like $1 million to $1.5 million first investment for a business that's kind of doing $1 million of ARR, and that's it's obviously there are some businesses we do which are much lower than that, and some businesses which are significantly higher than that. But that would be a typical deal. That's kind of the area where we think we can really make the business is kind of proven enough to be backable, but has enough room to grow to create returns. And the thing that we're really looking for, rather than one particular metric such as revenue, what we're really looking for is to, as I said before, find and back exceptional founders, but also really look into the momentum of the business. So how quickly is it growing? You can get to $1 million after 10 years, and that's not the same opportunity as someone who's got to 500 grand of ARR after 18 months. So we're really looking at that momentum, and also the big thing we're focusing on at the moment is kind of making sure that the businesses we back have really found what their ideal customer profile is, and that they've got a repeatable sales motion in place to be able to continue to sell to those. Again, looking at a business that's got $1 million ARR and has a customer in hospitality, a customer in legal, a customer in retail, a customer in, across a variety of things, that's not necessarily a representative of a business that's really found what it is that's who it is it's trying to sell to, and a repeatable sales motion. We're very much like being able to define what it is we're selling to and how we approach selling that, rather than I won this contract and I won that contract and I won that contract.
So Dave, how many companies can investors expect to get within their EIS portfolio? And do you have any recent examples of companies you've backed?
Yeah, so investors would expect to be in a portfolio of about 8 companies within their tranche of the growth fund. Some examples of recent deals we've just backed. So one is Seatfrog, which people might know as kind of the rail upgrade company. It's actually much more of a B2B business and more of a data play than that. The reason we invested in that is really quite simple. They have got to 1 million customers with 0 paid marketing. So real virality of the app, the consumer app. And they also have relationships with every single train operator in the UK, and a good proportion of them in Europe. So that's been performing brilliantly since we invested, has grown about 4x in the time since we invested, and is one we're really excited about for the future. 2 others that sort of are worth mentioning. Lunio is a Manchester-based advertising technology business. It's doubled for 3 years in a row in terms of ARR. We've been tracking it for quite a while. It's now at 6 million ARR. The founder is a super entrepreneur who has previously scaled and sold an agency in exactly the same space, and he's sort of going again to productize what he learned from his agency days. But he's growing that business really, really well. And the final one I'd highlight would be AccessPay. It's a 10 million ARR business, fintech sort of platform. And the reason we've been following that business for a long time. We've sort of seen them as they brought in a sort of a professional CEO, so not the founder, but the professional CEO that's come in as twice exited founder who's built businesses in that space, in that vertical, and he's really sort of professionalized the business and really started to. Again, it's all about that repeatability of the sales motion. How do you get from 5 million ARR to 7 million ARR to 10 million ARR, and then on to, and we believe if you can get to 10, then 20 and 30 is very much a possibility for that business.
And so how do you find these businesses, and then how do you win the deals?
I think one of the things we try a lot to do is really build our brand within the founder community. We are also slightly unique. We're based in Manchester, so there aren't many investors in this space. It's not the crowded market that you'd find in London. So I think what we're really trying to do is make sure that every founder in our region, in our sort of part of the world, knows who we are. And in an ideal world, we would become kind of the founder of choice for entrepreneurs in the north of England. We do that by massively participating in the ecosystem. I think last year we attended something like, we spoke at about 100 events across the region and in all the sort of founder startup parts of the world, and we just want to make sure that founders know of us and that they come to us and they're looking to us for genuine venture capital based in the north of England, and that's really worked for us over the last 5 years.
And when you back a business, are you looking to add value there, or are you finding a great management team and just leaving them to it? Or are you?
I think we're trying to do both. One of the things that I'm a really big believer in is kind of mentorship and helping founders to understand the things they don't know already. If you go back to when we started the venture side of the business, it was just before COVID hit, and that was a difficult time for everybody, right? I was very lucky. I started talking to a guy called Steve Corns, who was CEO, CFO of AO. So lots of people who bought washing machines from AO. He was there from 7 million of sales to 1.5 billion, did the float at 1.3 billion valuation. And he was an investor in our first fund. And we started talking during COVID. And I guess one conversation led to another, and then it became sort of formal mentoring and significant help to me as I've sort of navigated that path through COVID. And I guess at the end of 2020, I realized two things. One is I'd learned more about running a business in sort of 9 months working with a mentor who could help me and guide me than I had in sort of 9 years of just doing the best thing I could think to do. And also I thought, how brilliant would it be if every single portfolio founder within our portfolio got that level of support from mentors? And that led us to build something called the Operational Partner Network, which is a network of people like Steve, with track records like Steve, that are at the point of their career where they want to give back and they want to help the next generation of founders. So we have 8 or 9 portfolio operational partners who've all had amazing track records, either entrepreneurially or in corporate roles, who are able to just get stuck in and help founders as they build their businesses. That could be hiring executives. That could be how do we put a go-to-market sales motion in place. It could be just, I guess, the support that you need when things don't quite go to plan. And if you take the last couple of years, it's been a tough time to be a startup founder, right? The goalposts have slightly changed, the funding market slightly changed, the valuation market slightly changed, and I think that's something to navigate through. And one of the things that we've been able to do is really deploy that operational partner network to help founders build the best business they can and make the most of the opportunity they have.
So Dave, turning back to the Praetura portfolio as a whole, looking at some of your more established investments, any particular highlights there?
Yeah, so I guess a couple to highlight. We backed a business called Reacta a while back. It's a sort of life sciences allergen testing medical product. So really using peanut, milk and egg allergies. That we invested really at an inflection point where they'd built a technology. They hadn't yet got the distribution right. They didn't know quite how they were going to sell it, but they built a technology, and we believed passionately that this was something that the market needed and would be very valuable. I guess when we first invested, they kind of, took a while to get that distribution going. They've now, really hit an inflection point. And this year, in the next 12 months, they're forecasting to be sort of 3 million EBITDA. They've grown significantly. They're now 5 or 6 million, of revenue, huge partnerships with global pharma companies, and one that we're super excited about where it may go. Another one to mention that's probably really a good example of what we're trying to do, Percayso, which is an insurance tech business. We invested when it had a couple of $100,000 of revenue, but it had a very experienced second-time founder looking to do it again, and a really ambitious kind of MD, really looking to drive the business forward. That's grown in 2 and a bit years to 3 million of ARR. And we've been able to support that all the way along, including sort of using our own expertise for them to do an opportunistic acquisition of a business called Cazana out of Kazoo, just before Kazoo went into its own problems. And it's just a great example of what we're trying to do, which is back people who really know what they're doing in their space, help them as much as we can in terms of building the business and growing them from a relatively modest revenue line to sort of 3 million plus.
So turning to exits, clearly too early for the VCT.
Too early for a lot of our funds, really. So we have 40 companies that we've backed in the EIS funds. Only 7 of those are 100% through their 3-year EIS sort of requirements. So to be honest with you, exits this year is not really where our focus is. So of those, but I think there's always an opportunity for opportunistic exits, right? So of those 40 companies, about 20% have had significant strategic offers this year. The market, as you'll know, for exits is quite tricky at the moment. A lot of buyers are trying to put the risk onto the company. So the headline price might be quite large. We've had several above 100, but the actual upfront cash is not that big. So for us to kind of really get into those exit things, we need to see a higher cash up front and much less risk of the sort of the contingent element of the consideration. So let's say we've got 40, only about 15-16% of our portfolio are actually through their EIS sort of 3-year qualification period. 20% of our portfolio have had strategic acquisition offers. I guess what we're really focused on is in the absence of exits, because we're not at that stage yet, what are the evidence that we're building valuable businesses that are going to exit for significant returns? And again, if you take that 40 company and the average deal would be $1 million ARR when we go in, we now have 50% of the portfolio is 3 million or higher in terms of ARR. 25% of the portfolio is 5 million ARR above, and about 10% of the portfolio is 10 million ARR above. The biggest one we have in our portfolio is Modern Milkman, which is 50 million ARR, and the founder has just moved to the East Coast of America to build a business over there, and has already grown that part of the business to 10 million of recurring revenue. So I think what our focus on is really delivering on proving that we're building great businesses that will be very, very saleable and create significant value for our shareholders, but we're not yet at the point of exiting. And I think this would apply to all VCTs and EISs. This year 2024 is not the year of the mega exit. The values that people are looking to pay are quite opportunistic. So it would have to take something sort of out of the ordinary for us to look to really try and drive exits this year. We're about building value this year and exits in 25 and 26 and 27.
And turning to risk, how risky is your part of the market?
It's risky. So it's early stage technology businesses. It's businesses that haven't proven, they're not profitable. They're looking to raise capital. It might be a first or second time founder. That they're definitely not Apple and Microsoft. Yeah. There's risk, but with risk as long as you get the appropriate level of risk and reward, and obviously some of these have tax advantages to make sure that to sort of offset some of the risk. Our goal is to create significant capital value and multiples of return for our investors. To do that, you have to take risk. And anybody who sits in my position and says to investors, there is no risk, our portfolio is not risky, our portfolio is lower risk, I'd really ask how you can get to that conclusion. I think the only way would be, hundreds and hundreds of companies in a diversification perspective. But I think with that, you end up with a scenario where the money on money multiples are probably not going to be the same as you could get from a smaller portfolio of earlier stage companies.
True. So to sum up, Dave, for those that want to back an EIS fund or a VCT this year, why should they invest with Praetura?
I think for investors and their advisors, I think the reason to invest with Praetura is you believe in what we're trying to do, which is, invest in early stage founders outside of the traditional areas of the country. And the second reason for that would be a very significant diversification play. We are by definition looking at slightly different companies to the majority of VCTs and EIS funds. We're slightly fishing in different ponds. I know I'm mixing my analogies there, but effectively there is a natural diversification play to invest in someone like Praetura alongside other EIS and VCTs. We're never saying you should only invest in Praetura and it's the only EIS or VCT to invest in. There's plenty to look at, but we do offer a diversification. And on the VCT, I think the real thing that we're so excited about is the timing of our launch in 2024 means it is clean from sort of the market variations between 2021 and 2022 and the valuations that people are paying now. And we think it's a great time to get into a new VCT that's being built from 2024 onwards, not filled with companies from 2021 and 2022.
Very good. Dave Foreman of Praetura Ventures, thank you very much.
Thank you very much.
If you are watching on YouTube, please press like and subscribe to the channel for more.